Hi, and welcome back again to Option Optics, seeing what others don't. Taking a look at a bull put spread and iron condor trade on Oracle that is beaten down badly following the AI massacre here, but setting up, I think, ideally for a couple trades, a bullish put spread and an iron condor both. And as we always like to do, we always like to take a look at our fusion approach, fundamental analysis, technical analysis, and IV analysis. So taking a look at the valuation from a fundamental standpoint, here you can see that Oracle's price to sales and price to earnings have both come down sharply since the all-time highs from a little over a month and a half ago. You can see price to sales now back under 10 times, certainly not cheap by any stretch of the imagination, right? Price to earnings, PE ratio, back under 50 times, right? Which is still fairly lofty, but well off the highs over 70. Back to those levels we saw late in June of earlier in the year. And that's kind of our comparative here that we'll take a look at, which was last time the stock was trading at the current price. As we said, we like to take a look at fundamental and technical analysis along with IV analysis. So from a technical perspective, you can see that Oracle absolutely getting oversold. 9-day RSI at basically the lowest level we have seen pretty much over the past 12 months. The previous times it got this low, all marked lows in the stocks. MACD starting to get to levels we haven't seen in a very long time, but starting to show a little bit maybe of strength here. Same with Bollinger percent B. Briefly went negative back here, but still hovering right around that zero level. And then most importantly, as you can see, and we'll take a look at it more closely, IV at by far the highest level of the year, even though earnings aren't for a few weeks off. Earnings coming December 15th. So our trades that we're looking at will steer away from that expire before December 15th. And so we said we always like to look at IV analysis as well. So here's a few different looks at it. 30-day IV, we're going to be doing short-term trades. Here you can see 30-day IV at by far the highest level over the past 12 months, right? Simply because of the drubbing that AI and Oracle stock has particularly had. You can see it crept up again on Friday, but not egregiously so. You can see where it was not too long ago, right? October 27th, trading in the mid 40 level. Now we're well over 70. The shorter term trade that we're doing, even a little bit higher here. So you can see this huge spike in IV as fear has crept in, which means we can get a bigger premium for the same trade, or we can get further out of the money and get the same premium, or what we kind of did, combine both of them, get a little more premium, a little bit more cushion. Here's a different look at that IV. As you can see, once that kind of AI massacre started, right, here's earnings, the last earnings report we saw the stock come down sharply as always post earnings, right, but has exploded to by far the highest level over the past 3 months. So setting up ideally for a couple trades to take advantage of that. So doing just a quick comparative, right? A look back to June 13th, right, which on the chart was the last time the stock was trading at basically the same price, that 199-ish level, right? So that's a great comparative here. We can see that 190 put, right, was trading at $3.15. It was out of the money by just less than 10 points or just under 5%. Days to expiration back then on June 13th, 35 days to expiration. The IV just under 30 IV. Fast forward to Friday's close, stock virtually at the same price, a touch lower at 198.76, right? Now we can look at the 185 put, right, instead of the 190 put. So the stock basically down about a buck, right? But that 185 put, which is further out of the money, 13 and change out of the money versus just under 10. So you have a much bigger cushion, but you're getting almost 3 times the price for it. Why? Because IV is now well over 80, plus only 19 days to expiration, right, on the December 12th. And remember, we said earnings were coming December 15th, right? As we can see here, December 15th, Earnings, we want to stay away from that. So we went to the December 12th expiration. So we basically have 2 less weeks, which should make option prices a lot cheaper. But because of that huge jump in IV from under 30 back then, right, to over 80 now with the stock at about the same price, uh, provides a huge pickup in option premium. So a couple trades we're looking at: simple basic defined risk put spread, looking back to that June 13th time frame versus now, right? June 13th stock just under 200. That 190, 185 put spread, which was a little less than 10 points out of the money, trading a little bit over a buck, $1.11, right? 35 days again until expiration. So your max gain, $111 for each one you sell. Max risk, $389. So about a 28.5% return on risk with a little over, a 9.8 point cushion on that trade. And that equates to a decent percentage cushion, right? Simply take the downside versus the current price of the stock and roughly a 5% cushion on the trade. Fast forward to Friday's close, stock a little bit lower. Now we're looking at a 185, 185 points further out of the money. So a bigger cushion, right? 1376 now versus 986 then. So roughly about 4 more points downside cushion, able to get a much bigger net credit of $1.80. And remember, 2 weeks less time until expiration, right? And time to expiration should be cheaper, right? Cheapen the spread, but because of this huge jump in implied volatility, right, that we see that is now over 80, right, that provides a big cushion on the trade and also a bigger net credit. So we can sell the spread for $1.80 or 180 bucks per put spread, 320 max risk, so over a 50% return. So we have less time by 2 weeks, a bigger cushion by almost 4 points, right? And if you put that in percentage terms, remember last time it was around 5% cushion. Now we're looking at almost a 7% cushion. So you have a bigger downside cushion, much bigger return with less time to expiration, 2 weeks less time, which is a lot. Also, the iron condor trade, right? Define risk, but also bringing in a call spread, right? And I think that in front of earnings, you'll probably see these AI stocks more waffle around than anything. So again, looking back to June 13th, stock again just under 200 at 199.86. The iron condor that we're looking at back then was selling the 190 put and the 210 call and hedging by buying the 185 put for protection, buying or the 180 put, I should say, 10-point wide, and the 220 call for protection, right? So that iron condor priced at about $3.80. The IV on the trade back then in June, right, just under 30. Your upside was 210, so you had about 10 points of upside cushion, right, or a little over 5%. The downside back then, 190, right? We're selling the 190, 180 put spread, the 210, 220 call spread. Same sort of idea, about 10 points cushion, right? Or about 5% downside cushion. 35 days to expiration back then. We were doing our comparative max gain on the trade, was what you sell it for, 380 bucks roughly. Max risk is simply the strike difference of 10 points less that 380 or $620. So your return on risk, very nice back then, 61% or so. Fast forward to Friday, right? The stock closed at 198.76. That same iron condor, except much further out of the money. Remember last time we were looking at the 190, 180, the 210, 220, right? Now we're looking at the 220, 230, 10 points further out of the money to the upside, right? And the downside, the 175, 165, right? 15 points more cushion to the downside. So giving ourselves about over 20% cushion on, or 10% cushion on either side. Back then it was about 5%. So in essence, double the cushion, double the points, right? And you can see the days to expiration much shorter, 2 weeks shorter now versus then. So a shorter time frame, a much bigger cushion, and a much bigger net credit. You can sell it for 460 or 460 per spread. Max risk, 540, 10 points wide on either side. So return on risk of 85%. So this sets up ideally, I think, for either a bullish put spread for those who are somewhat more bullish looking for a rebound on Oracle and these AI stocks that have been beaten down in the submission, or more of a kind of vol capture neutral trade, right? Selling that iron condor, again, both in a defined risk manner. So that's what we always look to do here at Option Optics is look for the edge, then put on the hedge. And as we always know, right, trading at the end of the day is all about probability, not certainty. So make sure your position size correctly. So until next time, as always, here's a good trading.